For years, we've all heard the story of Japan's economic stagnation. It's always been told as this cautionary tale, right? A distant storm happening way over on the other side of the world. But today, we're going to look at the data, and it shows that storm has officially crossed the ocean. The Japan scenario isn't a forecast for the West anymore. It's the reality right now for New York, London, and Frankfurt.
To really get what's happening now, we have to understand where Japan's been. So let's just do a quick thought experiment. Picture this. The year's 1989. You're in Tokyo. Your stock market is an absolute rocket ship that only seems to go up. Japanese companies are buying up iconic buildings in Manhattan. There's this feeling, this absolute certainty that the future belongs to Japan, and that it's going to be that way forever.
So for the last 30 years, we in the West have looked at Japan's lost decades that came after that peak, and we saw it as a lesson in what not to do. A story about their unique mistakes. But what if we've been reading that story all wrong? What if it wasn't a warning, but a roadmap? What if it was a direct preview of the exact path we're on right now? Okay, let's dive into this.
We're going to start by looking at the hard data, because the numbers, well, they reveal a pretty startling convergence. They show the West walking step for step into the very same economic trap that has defined Japan for a whole generation.
You see, for decades, economists have used this term Japanification, a state of permanent low growth, low inflation, and rock-bottom interest rates, but they always talked about it as a theoretical risk, something that could happen. Well, the massive economic shocks of the last few years have just slammed on the fast-forward button. The Japan scenario is not a what-if anymore. It's basically the West's current operating system.
Now, what's really fascinating about this slide is just how eerily similar the blueprint is. Look at these foundational numbers. In the US, gross public debt as a share of the economy, it's nearly identical to where Japan was right at the start of its crisis. And then look at the engine of any economy, its workforce. It's stalling out. Just like Japan back then, both the US and Europe are now facing near zero or even declining working age populations. These aren't temporary problems, right? These are the structural pillars of long-term stagnation.
And this convergence, it's being accelerated by what analysts are now calling the triple deficit trap. And it is a vicious cycle. First, you've got a fiscal deficit. Governments are spending trillions more than they take in. Simple as that. Second, a trade deficit. You're just buying way more stuff from the world than you're selling to it. And the third one, the energy deficit, this one acts like a massive amplifier. When you're deeply reliant on imported energy, a single geopolitical crisis can send your costs spiraling. And that just makes the other two deficits even worse. It creates a perfect economic storm.
So when you have these three massive holes just bleeding your economy dry and a government that needs to borrow unprecedented amounts of money just to keep the lights on, who is forced to pick up the tab? Well, this leads us directly to the inescapable trap that's now facing the world's most powerful financial institutions, the central banks.
The result is a policy that Japan really pioneered out of pure necessity. It's called yield curve control, or YCC. And to put it simply, this is the endgame. It's what happens when a government's debt gets so massive that it literally can't afford to pay market interest rates anymore. Its own central bank has no choice but to step in. It prints new money to buy government bonds, and by doing that, it artificially forces, or pins, interest rates down to a level that prevents the entire country from going bankrupt.
This puts central banks in an absolutely impossible position, a choice between two disastrous outcomes. Path one is the crash scenario. Let interest rates rise to fight off inflation, but you risk a domino effect of government and corporate defaults as all their debt payments become totally unaffordable. Path two is the inflation scenario. Just keep printing money to hold rates low and fund the debt, but in doing so, you systematically devalue your own currency and you just incinerate the purchasing power of your citizens' savings. There is no good option here.
Now, this isn't just about making a tough choice. This is pushing Western economies towards a mathematical point of no return, a tipping point from which there might be no easy way back.
And this is that point of no return. It's a simple but absolutely brutal equation. It's where R, the interest rate the government pays on its debt, becomes permanently higher than G, the growth rate of the economy. For decades, it was the other way around. G was higher than R, so we could always kind of outgrow our debt. Well, that is flipped, and this activates a debt spiral, where the debt grows faster than the economy automatically. Think about that. Even if the government balanced its budget tomorrow, the debt would still grow uncontrollably.
And this chart, wow, it just brilliantly illustrates the urgency. Japan is the long-standing poster child for extreme debt, but just look how close the US and Italy are. When your debt-to-GDP ratio gets this high, you are in the danger zone.
It means that whole R is greater than G problem isn't some distant threat. A tiny gap between interest costs and growth can trigger that inescapable spiral right now.
So, this is the crucial point. How does this massive, abstract story about sovereign debt and central banks actually affect you? Well, it translates directly into a hidden and completely unavoidable tax on your wealth.
Let's make this really personal. You might open your banking app and feel pretty good seeing a high-yield savings account paying, let's say, 4.21%. On the surface, that sounds decent, right? But at the exact same time, the true cost of the things you have to buy, we're talking food, energy, insurance, housing, that's rising by an estimated 7% or maybe even more.
That gap means your real return is deeply negative. For every $100 you work hard to save, you are losing almost $3 in actual purchasing power, year after year after year. You're running on a financial treadmill, and the government just secretly cranked up the speed.
And here's the kicker. This isn't an accident. It's not a bug in the system. It is the main feature. This is a deliberate policy called financial repression. It is, for all intents and purposes, an invisible tax. By holding interest rates below the true rate of inflation, the government quietly erodes the real value of its own massive debts. Your loss is their gain. Your savings are literally being used to bail out an insolvent system.
So what does this all mean for us? Well, the key takeaway from all this data is that the old rules of money, of investing, they're broken. We are in a brand new era, and understanding the new rules is the first, most critical step to getting through it.
You know, the playbook for the next decade was written in Tokyo 20 years ago, and it spells out 3 new realities that we all just have to accept. First, forget free markets setting interest rates. Yield curve control in some form or another is here to stay because central banks have to keep governments solvent. Second, that debt spiral is no longer a theory, it's active. And third, financial repression means that we, the savers, have become the primary funding source for keeping this whole system afloat.
In all of this, it leads us to the one question that truly matters for our own financial futures. The system is now explicitly designed to slowly transfer wealth from savers to debtors through inflation. So the question we all have to grapple with is this. In an era where that is the stated goal, how do you protect what you've earned and stop your savings from becoming the fuel for someone else's bailout?